One push notification shatters a 40-year-old bank in just 36 hours. This is the real timeline behind Silicon Valley Bank and the simple moves that keep your cash safer. Esta Whitme. Thursday morning in March 2023, phones buzz across Silicon Valley. Group chats begin to repeat the same warning, and the message spreading through the threads says to move funds today. Within hours, a 40-year-old institution goes from beloved to broken. This is not a crypto implosion, and it is the story of safe government bonds held in the wrong way for the wrong moment. This story is for education only and not financial advice. Silicon Valley Bank was not a neighborhood ATM, and it was the startup bank that held venture-backed cash and paid founder payrolls. In 2020 and 2021, money flooded into tech, and deposits at this bank exploded. Banks do not keep all deposits in a vault, and they invest a large portion in securities to earn a spread. This bank bought high-quality, long-duration United States Treasuries and agency mortgage bonds that looked safe when rates were near zero. There is a catch hidden in bond math, and when interest rates rise, long bonds fall the most because of duration risk. You do not feel duration risk until rates jump, and then the losses show up fast. A large share of those bonds was labeled hold to maturity, which means daily market drops were not recorded as long as the bank could wait until the bonds paid back. That accounting works only if deposits stay put, and the moment customers want their money back early, the bank must sell and paper. Losses become real losses. That was the spring quietly coiled inside the balance sheet. Then the world changed when the Federal Reserve raised interest rates at the fastest clip in decades during 2022. The era of near-zero rates ended, and the cost of money jumped while long bonds sank. At the same time, the tech boom cooled as the IPO window shut and venture funding slowed, so startups began to burn cash instead of adding it. Deposits began to drift out just as the market value of the bond portfolio fell because of rising rates. In early March 2023, the bank tried a classic fix by selling about $21 billion of securities and taking a loss of about $1.8 billion. The plan was to raise fresh equity, restore confidence, and move on, but that plan requires time and trust. Suddenly, the bank had neither time nor trust. The announcement landed on a Wednesday evening, and by Thursday, morning questions detonated across social media and finance chats. Several prominent investors advised their portfolio companies to move funds immediately, and founders were told to wire their cash out without delay. In a paper world that would be slow, and in 2020, 3 online portals turned panic into a button press. Finance teams opened a browser tab, filled the transfer form, and pressed send. Withdrawals surged, and in a single day customers attempted to pull roughly $42 billion, which was an unheard of speed. This was not a line around a branch, and it was online banking systems compressing fear into hours. The modern bank run replaced shoe leather with bandwidth. By Thursday evening, liquidity was suffocating, and on Friday morning, regulators stepped in. The Federal Deposit Insurance Corporation took control, and Silicon Valley Bank was no longer operating as usual. Then the weekend cliffhanger began because many businesses had deposits far above normal insurance limits, and payroll was due on Monday. Founders and finance teams refreshed the news again and again while they waited for clarity. On Sunday night, a twist arrived when United States Authorities invoked a systemic risk exception and announced that all depositors, insured and uninsured, would be made whole at this bank, and another that failed the same. Weekend. Shareholders were wiped, and some creditors took losses while depositors were protected to stop a wider crisis. At the same time, the Federal Reserve introduced the Bank Term Funding Program, which allowed banks to borrow against treasuries and agency mortgage bonds at face value for up to 1 year. Borrowing at face value matters because par lending buys time when bonds are marked down by rate moves, and the program was designed to prevent forced selling and panic. What went wrong was not a single spectacular mistake, and it was a stack of ordinary risks that became extraordinary together. There was a duration mismatch because short-term deposits could leave in hours, while long-term bonds only repay over years, and when rates surged, the middle cracked. There was concentration risk because many customers belonged to the same ecosystem, listened to the same voices, and acted in sync, so correlation became acceleration. There was an accounting blind spot because hold to maturity can hide sensitivity to rate shocks until you sell, and once you sell, the losses are real and confidence drops. There was the speed of information, because rumors now move at the speed of a screenshot and trust can evaporate between breakfast and lunch. There were hedging and governance gaps because in a rising rate world, interest rate hedges are a seatbelt, and if protection is reduced at the wrong time, a sudden stop throws you forward. Pull any one of those layers and a bank wobbles and pulls several at once, and it falls. Beneath the headlines there was a human beat as finance teams felt relief when Monday payrolls cleared. Founders opened secondary accounts and learned exactly what deposit insurance categories mean. Small business owners discovered duration risk the hard way. Savers everywhere asked the same question, and that question was whether their cash was safe. Several lessons stuck after the dust settled, and the first lesson was to know the insurance rules. In the United States, federal deposit insurance generally covers up to $250,000 per depositor per ownership category per bank. An individual account has its own limit, and a joint account has its own limit, while certain trust and business accounts follow specific rules. If you sit far above those limits at one institution, you should spread balances across accounts and banks. The second lesson was to match money to purpose, because cash you might need soon belongs in safe and liquid places. Those places include insured deposits at reputable institutions, short-term United States Treasury bills or conservative government, money market funds at major brokers. You must understand the protections because a money market fund is not a bank deposit, but it holds high-quality short-term government assets and can be very liquid. You should not chase the last tiny bit of yield from a name you have never heard of, and you should prioritize safety and access. The third lesson was for small businesses and startups, which should write a one-page cash policy and follow it. That policy should keep 2 months of payroll in fully insured deposits and keep excess operating cash in treasury bills or a government money market fund. A secondary banking relationship should be set up for wires before it is needed, and insured cash sweep services can be considered if they fit the situation. The fourth lesson was to practice the boring drill before any storm, because preparation beats reaction. Once a year, you should pretend your main bank is frozen for 48 hours and verify. How you will fund payroll and pay vendors. You should confirm who has wire permissions at the backup bank and test the process when emotions are low. The fifth lesson was to stay curious without becoming paranoid. Because you do not need to be a bank analyst to spot a rough risk shape. Plain English summaries from your bank can help, and very large, unrealized losses in securities combined with a highly concentrated depositor base deserve attention. You are not predicting failure, and you are preparing, so you are not surprised. The weekend rescue did not happen because depositors deserved special treatment, and it happened to prevent missed payrolls and to stop fear from spreading through the economy. That was a policy choice, and it is not a plan you should rely on personally because your plan should work even if no rescue arrives. Here is the counterintuitive point, and it is that the lesson is not to avoid bonds forever, but to own the right structure. Bonds are tools, and if you need certainty soon, you should use short duration, while if you seek long-term growth, you should use a diversified, low-cost portfolio that matches your timeline and risk tolerance. The danger in this story was not the word bond, and it was the mismatch between the timing of promises and the timing of assets amplified by the speed of information. For weeks after the collapse, regional bank stocks swung and savers learned. The alphabet soup of accounting categories while regulators asked hard questions. Inside boardrooms and back offices, finance leaders updated cash checklists so the next surprise would sting less. This was not only about tech or social media, and it was about confidence. Confidence can appear quickly and vanish quickly, and it becomes fragile when basic mismatches go unhedged. A bank run today does not need a line around the block, and it needs a rumor, a screenshot, and a button. Structure your cash before the storm, not during it, and respect the limits and diversify your banking relationships and match your money to your needs. If you want more real finance stories and simple playbooks that show how to structure cash so a 36-hour bank run cannot derail you, subscribe now.